Hello, this is Connie Belden, and in this video we're going to take a look at IRR, internal rate of return, and uncertain cash flows. Now when we looked at net present values, we could tell if we were making above or below that required rate of return, but we didn't know exactly what the return was. So IRR can help us get an idea of what type of return are we actually earning on our investment. So let's assume we bought a new machine for $34,600. And it will reduce operating costs, giving us additional cash inflow of $6,500 per year for the next 6 years. So that's the equal amount per year, an annuity. On top of that, we can make an additional 2,500 units at a contribution margin of $1.60 per unit. And we're assuming no additional fixed cost. So what's the new machine's total annual cash inflows, the additional cash inflows we get from the new machine annually? Well, it would be $6,500, the amount it says we're going to save, plus another 2,500 units can be made at $1.60 per unit. So that gives us additional cash flows of $4,000. So when we add that together, additional annual cash inflows will be $10,500. Okay, keep that in mind, as that will help us here with the next two parts. So part 2 says, what discount factor should be used to compute the new machine's internal rate of return and take it to 2 decimal places? Okay, I provided you with the formula here. You want to take the cost of the new machine, which is given at $34,600, and divide it by those additional cash inflows that we calculated in part 1, and that is $10,500. So when you divide, you get 3.295 when I take it to 3 decimal places. Now that will be our discount factor. In part 3, in order to determine what type of return we are getting, we are going to go to table 14B2, because that's the annuity table, and we're going to look across the 6-year row for the discount factor of 3.295 and see what percentage that is the closest to. Okay, so I'm going to bring up the annuity table. I'm going to go across the 6-year row, and I am looking for 3.295. Now, I don't find it exactly, but you can see it's between 3.245 and 3.326. So as I look up, that is between 20 and 21%. So I went ahead and just put in my answer here that it is closest to about 20, but might be 21%. It's right in between those two. So that gives us the idea that we're making a 21% return on our investment. For every $100 we spend on the machine, we're getting $20 to $21 back in cash inflows. Okay, and then next, question 4. What if, in addition, instead of a 0 salvage value, we could, at the end of year 6, get that one-time payment of $13,755 as a salvage value on the machine? How would that change the internal rate of return? Now, we are going to have to do some trial and error here. I'm going to warn you about that to begin with. Okay, so we'll start with what we know. The purchase price of the machine will set us back $34,600. Okay. Now, it will be an annuity, as we will get an additional $10,500 in cash inflows each year. And it is a single dollar amount that at the end of year 6, we get $13,755 as a salvage value. Okay, now we know that that cash outlay for the piece of machinery of $34,600 is right now. So the discount factor will be 1. It will be itself. So therefore, its current value is what we're paying for it. $34,600, setting us back in cash flows. Now, for the rest of it, it's going to be trial and error to determine what the percentage is. I'm going to have to go to the annuity table and look across the 6-year line for this one, for the 10,500, because that's each year. And I'm going to go to the dollar table and look across the 6-year line for the salvage part. Okay, so let's start with the dollar table. And again, it's going to be trial and error. I'm just going to start with 23%. 6 years, 23% is 3.092. Okay, and then I'm going to go ahead and do the same thing, but I'm going to look at the dollar table. 6 years, same percentage. You got to stay with the same percentage. 23% is 0.289. Okay, now it helps to use Excel because that will make it go a little faster. So what I will do is I will multiply these together. Okay, and then I will do the same thing here. I will multiply these together. Okay, and now I'm going to add the three numbers together. Okay, so currently I have $1,841. So that means that since it's a positive number, it is more than a 23% return. I want to try and get as close to zero as possible to determine the return. So let's bump up to 25%. Okay, let's go to the annuity table. 6 years, 25%, 2.951. And since I used Excel, that changes my calculation. Now, I also have to go to 6 years and 25% on the dollar table. So 6 years, 25% right here, 0.262. Oh, and I reversed the numbers there. Sorry, it was 2.951. Okay, make sure you look at the tables correctly. And because I used Excel, that helped me out with my trial and error. So I'm down to a difference now of $11. That's probably as close to zero as I'm going to get. So therefore, the return is about 25%. Okay, moving on. We're going to look at uncertain cash flows in the next part of it. And this one, assume that you buy a piece of equipment for $760,000. It's going to give you an additional $110,000 per year for 8 years. That's an annuity again. And you have a required rate of return of 10%. So we're going to go back to calculating net present value using the annuity table. By purchasing the equipment, that will set us back. The purchase price is $760,000. Now I have cash inflows of $110,000 per year for 8 years. So I will go to the annuity table. I will look across the 8-year row. Okay, and my required rate of return is 10%. So right here, I am at 8 years, 10%. So make sure you're looking at it carefully here, 5.335. Okay, so I show you here, that's what I'm going to do. Take 110,000 times the discount factor that I found on the annuity table at 8 years, 10%. 5.335, and that gives me cash inflows of $586,850. Okay, when I take the difference, I do have a negative $173,150, so I should not do the project. Now, it may not always boil down to money or return. What about some intangible benefits, such as greater flexibility, higher quality of output? What's the dollar value of that? Well, to do that, you can take the net present value, which is a negative 173,150, and divide it by the discount factor that we found on the annuity table when we looked up 8 years and 10%, and right here, that's at 5.335. Okay, and when you divide that out, you come out with $32,455. So you have to decide, is that better quality worth the additional $32,455 or not? Thank you very much.